Welcome to Iron Financial, the only place where we forge stronger portfolios by cutting right through the market weakness. Today, we are putting SoFi Technologies under the microscope. Look, they just dropped their Q4 2025 numbers, and yeah, the market is buzzing. But our job isn't to follow the herd. Our job is to run the stress test. We're here to see if the structure is actually sound or if there are some serious cracks in the foundation that everyone else is just ignoring. Okay, let's get into it.
All right, the headline number is, well, it's a monster. For the very first time, SoFi has absolutely smashed through a major milestone. We're talking over $1 billion in adjusted net revenue for a single quarter. Just let that sink in for a second. $1 billion in 3 months. For a company that, a lot of people still see as just another disruptive fintech, this is the kind of heavy lifting the market absolutely demands to see. It's more than a number, really. It's a huge psychological barrier they just broke through. It's proof of concept that their model can achieve, well, massive scale. This is the number that gets all the headlines, but our job is to see if the rest of the report can actually support its weight.
And of course, here's the victory lap from the CEO, Anthony Noto. Exceptional, that's the word he used. And honestly, when you just glance at those top-line numbers, it is pretty hard to argue. You see growth, you see profitability, you see scale. It all looks picture perfect. Whoa, hold on a minute. Every skyscraper looks impressive from the ground, right? Exceptional is exactly what a CEO is paid to say. Our job is to get inside the elevator, check the wiring, and really inspect the load-bearing walls. An impressive facade, it can hide a whole lot of structural weaknesses. We need to know, is this growth built on solid rock, or is it built on shifting sand?
Exactly right, and that's precisely the plan. We're running a full diagnostic today. First, we'll dig into that billion-dollar quarter and the big headline numbers. Then, we're going straight to the foundation, their member and product growth. After that, we are going to deconstruct the 3 main business pillars to test their individual strength. Then we'll examine the blueprint for 2026, see what their future plans are. And finally, we deliver Iron Financial's verdict. This is the official stress test for SoFi's financial fortress. Let's get to work.
Okay, Section 1, the headline numbers. Now, these are the figures that are grabbing the attention of every single trader and analyst out there. This is the highlight reel SoFi wants you to see. So let's break it down and really see what's under the hood of this powerful-looking performance.
Now, what's really interesting on this chart is just the sheer velocity of the growth. Adjusted net revenue is up 37% year over year to that $1.01 billion mark. That's really strong. But the real story here, it's the profitability. Look at the adjusted EBITDA, that's a key measure of operating profit. It's up a massive 60% to $318 million. So what does that mean? It means their profits are growing significantly faster than their revenues. The margins are expanding. This is exactly what you need to see in a maturing growth company. It proves they're not just, buying revenue. They're actually growing more efficiently. And critically, and this is a big one, this is their 9th straight quarter of GAAP profitability, clocking in at $174 million. This is not some cash-burning startup anymore. This is a profitable financial institution.
All right, let's move on and see how this thing is built. A fortress is only as strong as its foundation, right? And for SoFi, that foundation is its user base. So, are they building a loyal army, or are they just renting a crowd?
Yeah, this is the crucial point for me. Revenue, that's a lagging indicator. Member growth, that's the forward-looking metric. Is the user base solid, or is it totally hollow? Let's inspect the bedrock.
Okay, the number is, well, it's staggering. In a single quarter, Q4 2025, SoFi added over 1 million new members. That is a record for the company. It brings their total user base to 13.7 million, which is a 35% jump year over year. Now, to put that in perspective for you, in this hyper-competitive environment for financial services, adding 1 million net new customers in just 3 months is a massive show of force. It tells you their brand, their product suite, it's resonating with the public. But, as we all know, not all members are created equal.
And this slide brilliantly illustrates the bull case. This isn't just growth, it's a powerful flywheel. You see that 35% member growth right alongside 37% products growth? So new members come in the door, they start adopting multiple products, they get locked into the ecosystem, and they just become more and more valuable over time. This is that one-stop shop strategy, just firing on all cylinders. The model is proven.
See, I see a different picture. I see a question of quality over quantity. 1 million new members, sure, it sounds fantastic. But who are they? Are these high-value customers taking out big loans and setting up their direct deposits? Or are they low-margin users who are just kicking the tires on a free checking account?
It's easy to grow if you're willing to just burn a ton of cash on marketing. The real question is, what's the lifetime value of these new members? Is the acquisition cost actually justified, or are they just chasing vanity metrics?
That's a fair challenge, a very fair challenge. And here is the answer. Look at this slide. 40% of SoFi members now use more than one product. That's your cross-buy statistic, and it's up 7 percentage points from the year before. This is not just a revolving door of low-value users. No, this is hard evidence that the ecosystem is sticky. They're successfully turning new members into multi-product customers, which, as you know, is the key to driving down acquisition costs and jacking up that lifetime value. The flywheel is real, and this proves it. The foundation looks solid.
Okay. Foundation inspected. It looks good. Now we move to the superstructure. We need to deconstruct SoFi's 3 core business segments. That's lending, financial services, and the technology platform.
Right. Think of it like 3 massive pillars holding up the entire company. If just one of them shows signs of stress or starts to crack, the whole structure could be at risk. And it doesn't matter how strong the others are. Let's see how they hold up under some real pressure.
First things first, let's just get the lay of the land. This chart shows you exactly how the weight is distributed across those pillars. Lending, their original business, is still the biggest contributor at $486 million. But look how close financial services is, coming in hot at $457 million. That's a massive shift from where they were just a couple of years ago. The tech platform brings in $122 million. So you've really got 2 main pillars doing almost all of the heavy lifting and a third, smaller one. Now let's stress test each one of them individually.
Pillar 1, lending. This is the original foundation SoFi was built on. And look, it's still an absolute powerhouse. They originated a record $10.5 billion in loans in the 4th quarter alone. And we're not talking about subprime borrowers here. We're talking about a prime book with an average FICO score of 746 on personal loans. The credit quality is rock solid.
Okay, rock solid, but it's showing its age. Look at the other side of the ledger here. Revenue growth in this pillar has slowed way down to just 15% year over year. Now, for a company that's valued on its growth trajectory, that is a big yellow flag. But here's the real crack I see. The contribution margin is shrinking. It's down from 59% all the way to 54% in just 1 year. That means for every single dollar of lending revenue they generate, they are keeping less profit after their variable costs. That's a direct hit to the bottom line, and it's a classic sign of either increased competition or just rising costs to acquire those loans. So this pillar is getting bigger, sure, but it's also getting less profitable at the margin.
Okay, so lending might be maturing a little bit. I'll give you that. But this is where the new skyscraper is being built. Pillar 2, financial services. The growth here is absolutely explosive. We're talking 78% year-over-year revenue growth. This segment is now almost as big as the entire lending business, and it is growing 4 times as fast. This is the new engine of the company. It's high margin, it's capital light, and it is doing the heavy lifting for SoFi's bottom line, plain and simple. It's impressive, I'm not going to lie, it's very impressive, but it raises a critical question of dependency. This one segment is now responsible for so much of the growth story. So if lending is slowing down and getting less profitable, can this new skyscraper truly carry the entire weight of the company on its own? It's strong for sure, but is it strong enough to compensate for cracks that are starting to appear everywhere else? A structure is only as strong as its most critical support, and believe me, this is rapidly becoming the critical support.
And that brings us to the 3rd pillar. And this isn't a crack. This is a major structural failure. A 23% decline. That's the year-over-year change in total accounts on their technology platform. This is the B2B side of their business, the part that's supposed to provide stable, predictable, recurring revenue from other companies. In a segment where you expect to see steady growth, a 23% drop is, well, it's a disaster. This pillar is crumbling.
So the question is obvious, right? What's behind this crack? The company line is that this is all due to a single client transition. Okay, but we have to ask the hard questions. Why does a key client leave? Did a competitor come in and offer a better price or a better product? Is there a fundamental flaw in SoFi's technology that's making it less competitive in the B2B space? Look, a 23% drop in accounts isn't a transition, it's an exodus. It suggests this pillar isn't just showing stress, it's actively crumbling. And management's guidance for only 20% growth next year barely gets them back to where they were 2 years ago. That's not a growth story, that's a recovery story at best.
All right. That's a significant point of weakness we've identified. You're right. The stress test is working. Now, let's shift from the present structure to the future blueprint. Where does SoFi go from here? What are the new materials and technologies they're using to reinforce their growth for 2026 and beyond?
Yeah, this is where we see if management has a credible plan to actually patch these cracks and continue building upward, or if they're just drawing up plans for some fantasy tower that they can't actually build.
Let's start with the hard numbers. Management has laid out a very confident and, I have to say, ambitious blueprint for 2026. They're guiding for 30% revenue growth, which would take them to about $4.6 billion. But again, look at the profitability leverage. They are projecting 45% growth in adjusted EBITDA and a massive 54% growth in adjusted earnings per share. This guidance, it tells the market that they believe the core business is incredibly strong and that they can continue to deliver powerful, profitable growth at scale.
And here's how they plan to fuel that growth. They are aggressively moving into next-generation finance. They launched SoFi USD, becoming the very first national bank to issue a stablecoin. They're using that to power SoFi Pay for international payments. They've relaunched crypto trading for their members, and they're weaving AI throughout the entire business. This isn't just a bank. They are positioning themselves as a true financial technology pioneer, building the infrastructure for the future. Or they're chasing hype cycles. Let's just be real for a second. Stablecoins, crypto, AI, these are the buzzwords of the moment. I look at this list and I see a lot of risk. How much real, tangible revenue is a stablecoin going to generate in the near term? What's the regulatory risk there? And re-entering the volatile crypto trading market? That seems like a really questionable move for a federally chartered bank, especially after so many of their competitors have been burned. To me, this feels less like a strategic plan and more like just throwing spaghetti at the wall to see what sticks, hoping to distract from the fact that their other pillars are showing some serious stress. It's incredibly high risk, and the payoff is completely uncertain.
Okay, we've run the tests, we've inspected the foundation, we've deconstructed the pillars, and we've reviewed the blueprint. Now it's time to synthesize all of these findings. Yep, it's time for the final verdict. Based on this stress test, is SoFi a well-engineered investment opportunity, or is it a cleverly disguised trap for unwary investors? The bull case is clear and it's compelling. The diversified, one-stop shop model is clearly working. The financial services segment has become an absolute monster of a growth engine, proving they can build new, powerful pillars. The foundation of member growth is not just large, but as that cross-buy data shows, it's also highly engaged. And on top of that, management has laid out a clear, confident blueprint for strong, profitable growth into 2026. This is a durable engine. But the bear case is just as clear. Our stress test revealed some very serious issues. We found clear cracks in the original lending pillar, with that slowing growth and compressing margins. We found a major structural issue in the tech platform, with that shocking 23% decline in accounts. The new ventures are highly speculative and could just be a major distraction. And it really seems like the market is pricing this stock for perfection, completely ignoring the very real risks that our inspection uncovered today.
So here's our final conclusion at Iron Financial. SoFi has built an undeniably impressive financial structure. The scale, the growth, the path to profitability, it's all real. However, our stress test has revealed that it is not flawless. There are clear points of weakness, specifically that slowdown in lending and the deep problems in the tech platform that investors absolutely must monitor. The overall structure is strong, but it's definitely carrying some vulnerabilities.
And that leaves you with the ultimate question. We've shown you the strength, and we have shown you the cracks. Is that new skyscraper, the financial services engine, powerful enough to not only support its own weight, but to also compensate for the clear weaknesses in the other two pillars? That's the billion-dollar question you have to answer before you decide if this is a structure worth investing in. Thank you for joining us at Iron Financial.